they said they see Cava as a rare category creator in the restaurant space, similar to Chipotle and Starbucks. I mean, these are two pretty big retail names there.
Category creator, that makes me think back to a restaurant IPO back in the day. Boston Chicken, which is now Boston Market.
Oh yeah.
And that was a category creator. And I remember the salesperson, I can't remember which firm I was at, came out with the pitch, and I heard the pitch, and man, it was compelling. And that stock ripped, and then it crashed. That restaurant business is tough.
It's tough. We're up about 99% from the IPO, but it's been a pretty volatile month for Cava. There's big up days, but there's also big down days.
Right.
Today, at least, it's positive.
It's a big valuation stretch, is what I've heard from a lot of analysts. Mike Halen at Bloomberg Intelligence says, boy, even at the IPO price, it was relatively richly valued to some of the peers. So you have to create a new category and give it a new multiple if you're going to put a buy rating on it today, and that's apparently what some of these.
And we are getting close to a lot of those buy ratings, so we'll see how the rest of the week goes. But I love Cava.
I've never been there.
Really
so
good.
Is it in this city?
Oh, Paul.
Yeah. Really?
Well, now we've got an
Now we've
activity
gotta go.
for you and I to bond over.
A little field trip. It's in the city?
Going to
It's
Cava.
in the city.
Okay.
There's one near Grand Central.
Union
Not
Square.
as many locations as Chipotle or Starbucks,
Okay.
but there's quite a few,
Okay.
and I think it's very good.
I'll get on that.
We'll
What
get
else
on
we got
that.
here?
So I'm also looking at Amazon. Not as much of a positive day for these shares, down now about 2.4%. There was an interesting column on the Bloomberg, the Tech Watch column from this morning, talking about how this week is Prime Week, but we have Prime Day starting tomorrow and Wednesday for Amazon. In the last 4 years, though, the stock has fallen for the week that was held during Prime Day.
Yeah.
In the 4 years before that, so 2015 to 2018, we saw an average gain of at least 2% for Amazon's stock. So the author goes on to argue that this now is suggesting Amazon shareholders and investors are more focused on AWS and Amazon's cloud business and not getting too excited anymore about the original business model of retail.
You know, I just put up I used the Amazon, put the ticker in, and then used Matt Miller's favorite function, which is COMP, to compare it versus other stocks. And here it gets the S&P 500. And on a 5-year basis, it's really trailing the market. That shocked me. It's up about 7.7% compounded annual return versus the S&P of 11.5%. I never would have guessed over the last 5 years Amazon lagged anything, much less the S&P 500, but there it is.
Right. People talk about its strength all the time, a bellwether stock, a mega cap. We'll see what happens this week. AWS is now the company's main source of operating income. So the retail business still accounts for most of Amazon's sales, but AWS, that cloud computing business, is responsible for more of the operating profit.
Well, it's interesting because later this week we sort of officially kick off earnings season when we start to hear from some of the banks. Talk to me about what we can expect this earnings season. If we do get better than feared results, are we going to see a huge rally, or is that sort of already priced in?
We will see, Madison, because for the last several earnings, all of this year and even at the end of last year, everyone said this is going to be the earnings season where everything finally cracks.
Everything changes.
These high valuations are finally going to feel the pressure of the Fed's tightening and higher rates, and so we're not going to see a big equity market reaction even if the beats are good. So that's the same message that I'm hearing this morning. We have Morgan Stanley's Mike Wilson, Paul, one of your favorites.
Yeah. Can we quote someone else?
Drilling down this message, but also Venki Chadha from Deutsche Bank also talking about how even if we get better than expected earnings, there's just not a lot of steam left to go in the equity market. So we might not get as much of a rally. But again, this is the message that we've been hearing for months, and we keep getting
going up
an equity market rally. So we'll see.
Yep, interesting stuff. Wall Street Journal reporting that the New York Times to close its sports desk and rely on The Athletic for daily coverage. So that is a sad day, in my opinion, having been a fan of New York Times. But in my opinion, they closed down their local sports coverage a decade ago. And then Joe Nocera, who used to work there and lots of other places, including Bloomberg, and was a sports columnist at the New York Times. He told me that about 7 or 8 years ago, the New York Times had kind of punted on local coverage, local news, local sports, and kind of becoming a national and an international paper. So that seems to be continuing right there. Yeah. All right, Emily Grafeo, thank you so much for getting us up to date on those markets. Let's talk about China here. Secretary Yellen there 4-day visit. Let's get the latest reporting. We've got a couple of smart voices here. Eddie Vanderwalt, Deputy Managing Editor of the Markets Live team with Bloomberg News, and Chris Condon, U.S. Treasury Reporter with Bloomberg News. Hey, Chris, I know you joined Secretary Yellen on the trip to China. What's the takeaway from ground zero there that you have?
Well, I apologize. Quick correction there. Our colleague Victoria Dendrino was actually on the trip.
Oh, okay.
I'm about
Gotcha.
to travel with her on her next trip. But,
Very good.
But I've obviously been keeping close tabs on this trip. It was, I have to say, first and foremost, there were low expectations in terms of what they call deliverables from this trip.
Right.
The main goal was to kind of stabilize the relationship and how the two countries deal with each other on economic issues and reestablish regular lines of communication. You know, if you go back before the Trump administration, U.S. and China kept a sort of pace of regular phone and in-person meetings with high-level Chinese staffers on economic issues, and that really fell apart due, first of all, to the more confrontational tone of the Trump administration, and then second, just because of COVID. And it's taken a long time to reestablish regular ties. And Yellen has been personally really eager to get those reconnected. And I think on that front, it was a pretty successful trip. From what I understand, she and her staff were very pleased with the way meetings went. They were a bit more informal as time went on. They weren't as scripted as they thought they might be. So that was a good thing. And she does expect from here, her staff will have that kind of regular pace of contacts reestablished where high-level people can get on the phone with each other and discuss concerns or just hit regular agenda items and discuss them. And that's a pretty healthy set of steps.
All right, well, Eddie, I want to bring you in, and Eddie, re-mentioning you are our Deputy Managing Editor of the Markets Live team. You have all of the best quotes that I steal throughout the day to say on air to sound smart, so thank you for that, Eddie. But I want to talk to you about some of this soft economic data that we got out of China, looking like that stimulus urgency is just increasing for the mainland there, Eddie. What is that sort of doing in terms of the impact on U.S. markets this week?
Yeah, look, these were really, really soft numbers that we saw from China. You know, globally, it's quite surprising to see, you know, with inflation around the world running so much above expectations and so much higher than most central bankers would like to see it. In China, they had zero inflation, literally nothing over the last year. The number came in at 0% flat. Core inflation slowed to 0.4%, and producer prices were in retreat. Now, yes, I mean, a lot of central bankers would probably look at that with envy, but it shows just how difficult the situation in China is and just how much, you know, there is maybe a need to kickstart the economy. Because remember, they only recently came out of lockdown, and it was when the rest of the world came out of lockdown that we had that really strong demand that fired inflation across the globe. But we're just not seeing that, and that's feeding through the market. It's certainly adding a little bit of a headwind to risk assets more broadly.
Hey, Chris, you know, how important is it? I mean, I guess, you know, covering the Treasury there, Secretary Yellen being in China is certainly important. Talk to us about how it kind of works under the, you know, when you get down into the makings of the sausage. Is there that much interaction between members of the staff of the Treasury and counterparts in China? Is this something that really needs to be nurtured?
Well, it certainly does need to be nurtured. It's something, as I said, that deteriorated over the last few years and is expected to restart now. And this can have a couple of different benefits. First of all, you know, Eddie was just talking about what we know about the Chinese economy. Well, the information coming out of China is not always believable or reliable, and those types of contacts help the Treasury at least gather more information, gives them a better read about what Chinese officials think is going on in their own economy. In fact, from these meetings, one thing that was taken away is that Chinese officials are concerned about growth and certain pockets of bubbles in their economy, but not overly so. They feel they have it under control. So that's the kind of insight or understanding that Treasury is always looking for more of. And second of all, it's beneficial in the sense that it might help prevent certain contentious issues from escalating in a sort of retaliatory cycle. It gives each side a chance to kind of communicate, intervene, talk things over, and prevent perhaps a more severe escalation of issues that begin as small economic concerns and could escalate.
Well, Janet Yellen kind of echoed the idea that it could escalate, saying that she wouldn't rule out the threat of a U.S. recession, and it's appropriate and normal for growth to moderate as inflation remains too high. So, Eddie, given that that kind of seems a little bit hawkish, and we're heading into this next Fed meeting here, likely to see another hike, to what extent is that move from the U.S. potentially going to impact China?
Yeah, look, there's definitely divergence of monetary policy around the globe, right? When we came out of COVID, everybody was in the same situation. Growth was very strong and we had fast inflation. And now we're starting to see real divergence. The U.S. is kind of in the middle of the road. It's inflation starting to come down, but it's not where it would like to see it. In China, the numbers are much lower now. I think there's a disconnect here because in the U.S. we're starting to see wages and the services sector driving that, whereas in China it's very much the manufacturing sector that is at fault. And I think as long as China's, as long as its services sector stays strong, then I think they will be shy of providing further stimulus. But I think there is definitely a feature between the two economies for sure.
All right, Eddie, thank you so much for joining us. Eddie Vanderwalt, Deputy Managing Editor of the Markets Live team, joining us from London. And Chris Condon, U.S. Treasury reporter with Bloomberg News, also joining us here, kind of giving us a nice little roundtable there, getting a kind of a recap, if you will, Madison, of the trip from Secretary Yellen. Again, establishing context. We saw that from Secretary Blinken before. So hopefully this might be a good for both sides. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, it's that time of year again, with earnings season kicking off this week. Bloomberg's Charlie Pellet reports.
Friday, we hear from J.P. Morgan Chase, Wells Fargo, and Citigroup. The earnings reports come amid a backdrop of inflation and Saunders is Chief Investment Strategist at Charles Schwab.
We know first quarter was better than expected. A lot of people are focusing on the fact that calendar year 2023 estimates are lifting, but that's only because of the beat in the first quarter. Second quarter, third quarter, fourth quarter, and even into first quarter next year have all had downtrends in their estimates. So that will come in clearer focus when we start to enter reporting season.
Thursday, it's Delta Airlines and PepsiCo with a focus on pricing power.
Thanks, Charlie. The parent company of Silicon Valley Bank is suing the Federal Insurance Deposit Corporation to recoup nearly $2 billion seized by the regulator after the lender collapsed in March. According to the Financial Times, SVB Financial in its lawsuit claims the FDIC violated bankruptcy laws by keeping the cash. The company also argues access to that money is critical for reorganizing. Silicon Valley Bank's implosion was the biggest U.S. bank failure since the 2008 financial crisis. And shares of Icahn Enterprises climbed as much as 16% this morning. That's after Carl Icahn confirmed amendments to previous loan pacts with lenders. Earlier, the Wall Street Journal reported the agreements untie his personal loans from the trading price of his company's shares.
Scalp issues.
I want out.
Serioxyl Advance by L'Oreal Professionnel with 5% stamoxidine for denser hair in 6 weeks. Serioxyl Advance. New start ahead.
Are you a Malaysian who want to master your finances? Here's a gift for you with a no time wasted guarantee. My name is KC Lau, a financial educator.
headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It is 10:21 on Wall Street. I'm Nathan Hager. Major banks are facing one of their biggest regulatory overhauls since the financial crisis in the light of the recent regional turmoil. Federal Reserve Vice Chair for Supervision Michael Barr says he wants banks to start using a standardized approach for estimating credit, trading, and operational risks rather than their own estimates. He also says the Fed's stress tests need a rejigger to better reflect the risks that banks face. Right now, the KBW Bank Index is higher by 0.6%, and financials are one of the 6 main industry groups in the S&P 500, helping the index to post a bit of a gain this morning. We check the markets all day long for you on Bloomberg, and right now the S&P is higher by 11 points, or 0.3%, trading at 4,410. The Dow is up 195 points, or 0.6%, at 33,931. And the NASDAQ is just posting a little bit of a gain here, up 19 points, or 0.1%, 13,680 for the NASDAQ. The 10-year Treasury is up 9/30 seconds, yield 4.02%. The 2-year yield is at 4.89. NYMEX crude is down 0.3%, down 24 cents at $73.62 a barrel. COMEX gold is down about 0.25%, or $4.70 at $19.2780 an ounce. The euro, 1.0976 against the dollar. The yen, 141.63. And Bitcoin's higher by almost 0.4%, trading around 30,300. The New York Times is confirming it's shutting down its sports desk, now relying on the Athletic website, which it bought a little bit more than a year ago for sports coverage. The move affects more than 35 journalists and editors on the Times sports desk. The New York Times stock is higher by 1.33%. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Madison Mills.
All right, Nathan Hager, thank you so much. We appreciate it. You know, I've followed the New York Times Company as an analyst for 30 some odd years.
Yeah.
They are one of the very few newspapers globally that have really created a viable and growing digital presence.
Yeah.
So, but
it's like the overwhelming portion of their revenue now.
Yeah,
is
yeah. It's been a great great story. They've done a great job. The Washington Post, the Federal, the FT, and the Journal as well. Looking at the stock, it's up 24% year to date, up 38% over the trailing 12 months. So good for them. But it is sad to see them kind of back away even more, and now completely from their sports coverage. Grew up with that. All the great reporters and columnists there from the Times over the years. All right, nobody covers the Fed, I think, any better or any more intensely than Bloomberg News. But one thing that's fallen through the cracks for me as a reader is like, what's going on with quantitative tightening, that QT thing? Is it still a thing? I don't know. But I know somebody who does know this stuff. It's Liz McCormick. She's a chief correspondent, macro markets with Bloomberg News. She actually follows this stuff. I don't know why, but she joins us actually here in studio. Liz, talk to me about and talk to us about quantitative tightening. Is the Fed still doing it? How are they doing it? Is it important? What's it mean for the economy? And tell us how they kind of screwed up maybe a couple years ago.
Yeah, I'm going to tell you all that. But fun fact, Liz Capo McCormick's brother used to work at Bloomberg Sports years ago.
wow.
We'll talk about that later.
Bloomberg
Yeah.
Sports. Whoa.
Yeah, but yeah, QT is still, we kind of got off the limelight with that, but it's still going on. In fact, in full force, it's going to be about $1 trillion a year that'll come off the Fed's balance sheet. And it was so interesting. I mean, maybe I'm just a nerd, but listening to Chairman Powell speak on Capitol Hill recently, and he, politicians really don't like all the debt on the Fed's balance sheet. I think they feel like it takes too much, sway in the market. And they were kind of saying to him, hey, you're going to get the balance sheet down. And Chairman Powell, like you're alluding to, Paul, said, we are, but we were going to be careful. In 2019, we didn't see it coming that there was scarcity in the banking system for reserves, which created problems. So the Fed had to quickly reverse course. Remember the repo blow up, and add reserves. So they're doing their job. They want to get the balance sheet down, but they're being very careful to not make reserves too scarce in the system. So it's not so easy, right? So I think Powell, I give him credit, was saying like, hey, we learned from the last time. We're trying to avoid it, but yeah, it's going on in the background. It's the second tool of their tightening.
So in terms of that being the second tool of their tightening, do you think that the Fed is secretly a little bit excited when bad eco news comes out and they have an excuse to raise rates again because it helps them with their balance sheet if rates are higher?
Yeah, that's funny, right? They would never say that, right?
Yeah.
But they would like, on everything to when you kind of go one way, you want to go back the other way so you have some ammo for the next crisis, right?
Yeah.
So it's tough if you start, every new crisis with an even bigger balance sheet, even though you've done some quantitative tightening, bringing it down. So I think the Fed would really love, like Janet Yellen, I think, was famous for saying, we want QT to run in the background like paint drying, which doesn't always work. But I really do think they're in a new regime. Well, they'll never have the uber small balance sheet that we all saw years and decades ago. But yeah, they would like to get it down a little, Maddie, right? Yeah. So if we, God willing, we don't, but if we go in another crisis, they have the ammo with the ability to cut rates and then jack up the balance sheet again. So it's a little bit of a tricky wicket, I call it, for them.
Yeah.
How does a central bank actually do quantitative tightening? How does it work?
Yeah, so, the central bank, it's easy when we know they're buying. QE, right. They just go in there and buy, right? But the quantitative tightening, let's talk about the Treasury side. So what happens is they have Treasury debt that matures. Say they have debt maturing middle of this month. What they'll do is say, hey, we're going to let that mature. Normally, if they're leaving their balance sheet stable, then they buy the same amount that matures. And now they're saying, hey, we're going to let X billion mature and not buy more. So that kind of whittles down how much treasuries they have on their balance sheet. The mortgages are a little more convoluted because depends on refi rates and things like that, but that's what they do, kind of not keep rolling into new debt.
And what does the impact of that look like in terms of overall liquidity?
Yeah, so it's interesting because QE, the buying was really and is used to kind of help lower long rates. It's felt to help juice the housing market and things. So QT, in a sense, should go the other way. It's a little less clear, but what it does on the short end, like we're talking about in this story, is what it does is, kind of the way all the mechanics work on the Fed's balance sheet is if they let the asset side roll down, then a liability has to roll down. So that's either in bank reserves or this facility they have, reverse repos, where money market funds can put money with the Fed. So that's where, Manny, if we get too tight, then that liquidity is sucking out of the short end, and that's kind of what churns, the financial system, right? Banks having enough liquidity to do their operations. So that's where, on the exit side of QT, that you have to worry about liquidity in the repo market and things like that.
So, Liz, how about, let's just assume I'm on the Fed, and at the end of this month, I argue to my fellow folks on the Fed, hey, we raised rates 500 basis points. Inflation's coming down. We just saw a 3% headline print. We're done. Let's just sit on the sidelines. Why do we have to do anything? It's actually working. Why don't we just do that? What would happen if I made that pitch?
Well, on the rate side, I think that's what they're going to eventually get to. Let's just say they hike in July. I can't remember if that was in your scenario.
Well, no, my scenario was don't do anything. We're done.
Well, right. Yeah. So say they don't, which is possible, right? Now, that's the one tool of their policy, the rates. So in that scenario, what the Fed has been saying is, QT is going to keep going, right? Where it gets tricky is the Fed has always said, I'm sorry, I'm Italian, I talk with my hands. We don't like our tools to be moving in opposite directions. So say, which we're far away from that, the Fed started lowering its benchmark rate. Then if QT is going on, it's like one hand of the Fed is easing and the other is tightening. And most people say the Fed won't want to do that. Like the folks at TD who see easing later this year say the Fed's going to stop the QT because it doesn't make sense to be going in opposite directions. But there's a lot of variables, so we don't know. So it's going to be interesting to see what happens in July. I'm already thinking about August and Jackson Hole. What guidance does Chairman Powell give us?
Should I go to Jackson Hole?
Yeah, let's go.
Of course you should go, Paul.
All right, I'll put a ticket in for that. See how that works.
What are you anticipating then in terms of Fed moves? It feels like July is a definite. Do you have a take on September?
Yeah, I think that's the wild card now. We're already kind of looking through into September. And there's a mix. There's a lot of economists on Wall Street who say one more July and we're done. Then there's others saying, hey, the Fed has more to go. We're not seeing policy really be that restrictive because look at the stock market, look at the housing market. Right. So some are saying, terminal rate has to be even higher, maybe over 60%. So I think I was talking to, the folks around my desk today, and we were saying, It really, it sounds boring, but it's going to be data dependent. Like if it's like you were saying, the data, if we start getting another strong jobs, if CPI misses to the upside, we have a lot of data between now and September. The Fed kind of has to do, if inflation is not coming down, they're going to have to do it. So I feel like, oh my God, will we ever get a break? It's not going to be calm, right?
Yeah.
You know.
So again, it seems like we were just getting some data passed around the newsroom here, talking about used car prices coming down. I mean, there's so many data points that you can look at here, but does the Fed feel like, in order from a credibility perspective, they need to hike one more time? Is that kind of where we are?
Well, you know, an analysis on Wall Street goes that the Fed doesn't like to surprise the market, and when the market, like the futures and the short-term overnight interest rate swaps, are pricing in like a near certainty that they hike in July. Fed doesn't like to surprise, so I don't know if it's credibility, but I don't think they want to upend the market. We're so close to that meeting, right? I mean, I could be wrong, but I suspect that they kind of have it priced in already. It's almost like a done deal. Like, let's just do it, right?
Yep, and if you look at the warp function, which Liz is referring to, it's almost a 90% expectation that rates will be hiked in July. So to the extent you don't want to upset the apple cart, there we go. All right, Liz McCormick, thanks so much for joining us here in our Bloomberg Interactive Broker Studio. Always good to see you in the office here. Liz McCormick, Chief Correspondent covering the global macro markets for Bloomberg News again. So we'll have some economic data this week, some inflation data this week, CPI, so it'll be really interesting, PPI as well. Get a good read on inflation, which the Fed will certainly need prior to meeting at the end of this month. I guess we'll get an announcement on July the 26th. Right now, let's head down to Washington, D.C., world and national news with Amy Morse.
All right, thank you, Paul. President Biden, as you know, is in London, a stopover on his way to the NATO meeting in Lithuania. UK Prime Minister Rishi Sunak spoke of increased economic cooperation.
Great for us to carry on our conversation, which we were having just a month or so ago, it feels like, in the White House, where we signed the Atlantic Declaration, first of its kind economic partnership.
Later, President Biden met with King Charles III at Windsor Castle. That was their first meeting since the king was crowned. As NATO leaders are gathering for that summit, North Korea now ramping up tensions by accusing U.S. spy planes of violating its airspace and threatening to shoot them down. North Korea claimed that drones and spy planes flew for 8 straight days along its coastline, with aircraft violating its airspace. The Kremlin spokesman says Russian President Vladimir Putin met with Wagner leader Yevgeny Prigozhin days after a short-lived rebellion by the mercenary chief and his private army. A Kremlin spokesman says it was a 3-hour meeting that took place June 29th and involved commanders from the military company that Prigozhin had founded. Congress is back in session after the 4th of July break. The biggest item on the agenda in the House of Representatives is the $886 billion National Defense Authorization Act, which conservatives are using as a platform to object to what they say is progressive social policy from the Pentagon. And the Senate Democrats on the Judiciary Committee want to work on establishing ethics standards for Supreme Court justices. And disgraced sports doctor Larry Nassar has been stabbed multiple times during an altercation with another inmate at a federal prison in Florida. He's serving decades in prison after being convicted of sexually abusing female gymnasts, including Olympic athletes. Sources tell the Associated Press that Nassar was stabbed in the chest and back yesterday and remains hospitalized in stable condition. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. I'm Nathan Hager. Stocks are fluctuating. Bonds are holding on to some gains at the start of a week that'll bring key inflation readings, a slew of Fed speak, and the beginning of U.S. earnings season. The S&P 500's hovering right around the 4,400 level as a growing chorus of Wall Street strategists tell investors this earnings season probably won't fuel fresh stock gains. Rock Creek Managing Director Alethea Doriwala says diversification is key.
Growth is going to happen in particular niche sectors and areas. So we are investing quite a bit right now in alternatives. It continues to be very interesting. Investors can take advantage of those secular long-term trends. U.S., Europe, emerging markets. You see tailwinds from the IRA and climate infrastructure projects. You see huge innovation in AI. You see things happening in agriculture technology, healthcare, data centers.
We check the markets all day long here at Bloomberg. Right now, the S&P 500 is little changed, up 3 points, trading at 4402. The Dow is up 140 points, 0.4% gain, 33,875. The NASDAQ is little changed to lower now, down 5 points at 13,655. 5 of the 11 main industry groups in the S&P are in the green, led by industrials and healthcare. Utilities and communication services are the biggest laggards right now. 10-year Treasury is up 6/32 for a yield of 4.03%. The 2-year yield 4.91. NYMEX crude is down 0.1% or 8 cents lower at $73.78 a barrel. COMEX gold is down 0.3% or $5.90 at $19.2680 an ounce. The euro 1.0968 against the dollar. The yen is at 141.78. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Madison Mills.
All right, Nathan Hager, thank you so much. We appreciate that. Madison Mills and Paul Sweeney here in our Bloomberg Interactive Broker Studio. And, of course, you can see us on YouTube. We're live streaming there. Just go to YouTube, search Bloomberg Global News, and you'll get our video feed there. Some fun stuff. Last Friday, payroll day, jobs day, came in a little less than expected, but I don't know. I think this job market's still ripping. I mean, the unemployment rate fell down to 3.6% from 3.7% last period. So that's about as low as it's probably going to get. I don't know. Let's check in with somebody who kind of does this stuff for a living. Kate Duchesne, CEO of RGP. RGP is a publicly traded company, and the symbol, coincidentally, is RGP. So you put that into your Bloomberg terminal. Kate, what did you make of the employment data? What do you make of today's employment data? What are you seeing out there?
Well, we're still seeing a very strong labor market. Labor participation rates are still well below what they were in February of 2020, and we still think it's a talent market.
So you still think it's a talent market, but it doesn't necessarily feel that way, right? It feels like increasingly we're hearing CEOs and employers calling people back to the office. Do you think that the talent pool today has as much power as they did a year ago?
They might not have quite as much power, Madison, that they did a year ago, but it's still on balance, I think, a talent market. We are reading headlines of CEOs asking for workers to come back on site. It's in our experience, and we work with some of the largest companies in the world, it's still very much a hybrid environment, and that the employers who are demanding full-time return to the office are losing that battle and slowly moving backwards on that command. And that's what we see. I mean, talent has formed very strong opinions coming out of COVID about what works and what doesn't, and how much control and choice they want, and they are expressing that. And, you know, labor participation rates are one of them, because people are also moving into more gig work and making choices about what works for personal and professional blend.
How about a garden variety recession? Will that impact kind of maybe that balance between the workers and the employers in terms of coming back to work? Are you hearing that from any of your clients?
Well, I think everybody's still in a wait and see. We've been talking about this recession now for months. Yep. It's not here yet. In our client base, we still see clients holding back a little bit on starting new projects, waiting to see is it going to get worse before it gets better. But I'll tell you, given how strong the labor market is, given the news we saw on wage inflation, it still feels like there's a lot of robust economic activity out there. Now, a recession might cause a pause. People tend to get more conservative in the face of real negative economic news. But remember, we're also seeing a change in demographic, and the demographic that's the majority of workforce now. And millennials and Gen Z have a very different relationship with work than baby boomers did.
Well, it's interesting you bring up demographics because I've been thinking about how the overall unemployment picture really varied across demographic lines, particularly when it comes to race, looking at black workers accounting for close to 90% of the increase in jobless claims since April. Can you talk to me about what you're seeing in terms of racial disparities and differences when it comes to the jobs data and hiring?
Right. I do think it's, that's terrible news for us. I mean, I think that to have the African American rate so high is something that we need to work on as a country. We see it more in gender really than race, and that is that, women who have made different decisions coming out of COVID, especially when they bore the brunt of childcare, have tended to remain out of the traditional workforce in higher numbers than men. I think that's moderated a bit, but you do see populations of workers, again, making different choices and choosing to bring their skills to the market in different ways. It used to be it was either full-time employment or nothing, and today there's so many different choices about how you can earn a living and choose to bring your skills to the marketplace, whether it's gig work, independent work, and those choices exist now in ways that they didn't, 10 or even 20 years ago.
Kate, another kind of labor statistic we look at is the JOLTS number, the job openings, and that's a number that historically has been, 4, 5, 6, 7 million openings, and it's been running at 10 million, 11 million, 12 million. We're down to 10 million today. Are those people ever going to come back to work? Are they out of the workforce, do you think?
I think many are out of the workforce, but we also have a real imbalance in our labor force given retirement demographics and also our immigration policy. So you really have to dig in what category of worker that you're talking about. But I think this imbalance in available work and available talent is going to persist. That's not something that's going away when recession worries going away. That's something that is going to exist for the foreseeable future. It's also one of the reasons that AI automation are